Reversal from bear to bull market. The first intermediate up phase of a bull market is usually accompanied by a substantial expansion in volume that is significantly greater than those of previous intermediate up phases. In other words, the first up leg in a bull market attracts noticeably more volume than any of the intermediate rallies in the previous bear market. Another sign of a basic reversal occurs when prices retrace at least 80% of the previous decline. Again, the greater the proportion of retracement, the greater the odds of a reversal in the basic trend. If the retracement is greater than 100%, the odds clearly indicate that a reversal in the downward trend has taken place because the series of declining peaks will have broken down. If the retracement is greater than 100%, the odds clearly indicate that a reversal in the downward trend has taken place because the series of declining peaks will have broken down. Since volume normally expands substantially as the intermediate down phase during a bear market reaches a low, a shrinkage in volume during an intermediate decline could well be warning that the bear market has run its course. This is especially true if the price does not reach a new low during the intermediate decline, since the series of declining intermediate cyclical lows, which is a characteristic of a bear market, may no longer be intact. An example of this is shown in chart 8.2, where the overall peak in volume was seen in the June 1962 decline rather than the August October sell off. A final sign might include a mega overbought condition or an extreme swing. Again, please refer to chapter 13 for an explanation of these concepts. Intermediate trends in the US stock market 1897 to 1982. Amplitude and duration of primary intermediate up moves. Between 1897 and 1933, Robert Rhea, the author of Dow Theory, classified 53 intermediate trend advances within a primary bull market, which ranged in magnitude from 7 to 117%, as shown in Table 4.1. I have classified 35 intermediate term moves between 1933 and 1982, and the median averaged 22% from low to high. The results are shown in Table 4.2. The median average primary intermediate advance since 1897 appears to be around 20 to 22%. The median primary intermediate up move in the 1933 to 1982 period does not differ from that of the earlier period classified by RIA. However, the median duration appears to have increased considerably from 13 weeks in 1897 to 1933 period to 24 weeks in the 1933 to 1982 period. Table 4.1. Primary intermediate up moves 1897 to 1933. Proportion of intermediate moves price magnitude. Amplitude and duration of primary intermediate down moves. Using RIA's classification, 39 cases of a primary intermediate decline developed between 1900 and 1932 as summarized in Table 4.3. My research shows that between 1932 and 1982, there were 35 primary intermediate declines with a median of 16%. The decline was measured as a percentage from the high. The results are summarized in Table 4.4. The results in the 1932 to 1982 period did not differ appreciably from those in the 1897 to 1933 period. Ria's median average swing was 18% as compared to the more recent 16%, whereas the median duration in the earlier period was 13 weeks, as compared to 14 weeks in 1932 to 1982 period. Amplitude, duration, and retracement of bull market intermediate corrections. Bull market secondary reaction. Between 1898 and 1933, RIA classified 43 cases of bull market secondaries. In terms of retracement of the previous primary intermediate up move, they ranged from 12.4 to 180. Table 4.3 Primary Intermediate Down Moves 1900 to 1932. Proportion of intermediate moves, price magnitude. This compared with the range of 1933 to 1982, period from 25 to 148% with a median of 51%. The duration of the median in the earlier period was 5 weeks as compared to 8 weeks between 1933 and 1982. The median percentage loss was from the previous primary intermediate peak of 12% between 1933 and 1982. Bear market rallies. RIA estimated that the median bear market rally retraced 52% of the previous decline, which is comparable to my own median estimate of 61% in the 1932-1982 period. The two ranges were 13 and 116% and 26 and 99% respectively. Median durations were 6 weeks in 1998 to 1933 and 7 weeks in 1932 to 1982. Rallies of the low averaged 12 and 10% for mean and median respectively for the 1933 to 1982 period. Since 1982, charts 4.1 and 4.2 show the S&P composite between the end of 1982 and the opening of 21st century. The thick vertical lines approximate intermediate rally peaks and the thin ones intermediate troughs. The lower panel contains an intermediate oscillator, the intermediate no sure thing KST. See chapter 15 for an explanation, which roughly reflects the turning points. This period encompassed the secular bull market that began in 1982 and ended at the turn of the century, as well as a subsequent secular bear. The classification of intermediate trends was particularly difficult compared to previous periods. I tried as much as possible to make the intermediate trends fit the swings in the oscillator because oscillators have a tendency to lead in bull markets. The actual peaks in the intermediate rallies usually lag those in the KST. The two charts show that the classification of these trends is far from a precise task and confirms earlier research between 1897 and 1982 that the range of intermediate trends varies tremendously. In the period covered by chart 4.1, for instance, the first intermediate rally in the bull market lasted well over a year from August 1982 to October 1983. Even if I had taken the July 1983 top as a reference point, the rally would still have lasted for almost a year. Moreover, the whole year of 1995 was consumed by one complete intermediate advance. Chart 4.3 fills in the balance of the picture until 2012. Note the particularly lengthy 2008 and 2009 trends, first on the downside and later on the upside. Chart 4.3 S&P Composite 2001 to 2012 and an intermediate KST. Summary. The typical primary trend can be divided into 2.5 primary intermediate cycles, each consisting of an up move and down move. In a bull market, each successive up wave should reach a new cyclical high, and in a bear market, each successive down wave of an intermediate cycle should reach a new low. Breaking the pattern of rising lows and falling peaks is an important but not unequivocal warning of a reversal in the primary trend. For more conclusive proof, technicians should derive a similar conclusion from a consensus of indicators. A secondary movement or reaction is that part of an intermediate cycle that runs counter to the main trend. A downward reaction in a bull market or a rally in a bear market. Secondary intermediate movements typically last from 3 weeks to 3 months and retrace between 1/3 and 2/3 of the previous primary intermediate price movement. Secondary price movements may also take the form of a line or a horizontal trading pattern. The character of an intermediate cycles can be used to help identify primary trend reversals. As an approximate rule, the stronger an intermediate rally in a bull market, the less that retracement is likely to be. An approximate rule, the stronger an immediate rally, the stronger an intermediate rally in a bull market, the less the retracement is likely to be.